This is chapter 21, part 3. So we're going to continue on with variable costing. The last topic we're going to discuss is the income statement. And under both the absorption and contrast that to the income statement under variable costing. And the income statement under variable costing is similar to the income statement that we had in the previous chapter. We had sales minus variable costs equals contribution margin minus fixed costs equals operating profit. So it's just a variation of that with a little more detail. I'm going to use the same example that we went through before, and we can just take a look at it. So here's our income statement right here. And what I've done is basically going to do it for both production scenarios. So here's our income statement. And for both scenarios, for the production of 100 units and the production of 1,000 units. Okay, and we'll start off first with absorption. The only other assumption that I changed was that we're going to have selling and administrative expenses, which are operating expenses, variable selling and administrative of $400 and fixed selling and administrative of $200. So this is the only change that I've added to our set of assumptions. So first of all, for absorption, this is our standard GAAP income statement, multi-step income statement version. So I'm going to have sales. Now the book sets it up a little bit differently, and we'll walk through that in the homework section, but to keep it just real simple for right now, and based on the numbers that we've put together, just so that we can see the difference in how the income statement is constructed. But again, we have sales. In both scenarios, we had $3,000 of sales under both production of 100 units and the production of 1,000 units. Of course, the next item on our income statement would be cost of goods sold. And I think in the book, the way it's set forth is we had total production less any change in fixed costs and ending inventory. But here we're just going to work off of the T accounts that we have, and so we're just going to use the cost of goods sold number that just comes right off of our T account. So here, under the production of 100 units, we'd have cost of goods sold of $2,000. And of course, cost of goods sold under the production of 1,000, we'd have cost of goods sold of $1,100. The next line, of course, is gross profit. Just going to abbreviate here a little bit, keep things moving along. So we have 1,000 under the 100 unit production scenario, and of course we have 1,900 under the 1,000 unit production scenario. So that was what we did before. Next we'd have our operating expenses, so selling and administrative expense. And of course here our total there, we don't break them out between fixed and variable. We would have a total of 600 for both scenarios. And so our operating income under the 100 unit assumption would be 400. And of course, under the 1,000 unit assumption would be 1,300. And again, that difference is $900, which again is the fixed costs in ending inventory that produce that difference. Those fixed costs are not flowing through cost of goods sold. They're being captured in ending inventory. Therefore, our cost of goods sold is $900 less, and that's going to increase our operating income by $900. All right, so let's take a look at variable costing. So variable costing, again, our income statement is going to follow our variable cost income statement that we had from the previous chapter. Let me just move this up so we have a little bit more room. So the first thing we're going to start off with, again, is sales. And again, both scenarios are going to have the same sales figure. Then what we're going to do is, again, we want to break this into variable cost and fixed cost. Right? So what we're going to do is, first of all, split up the variable manufacturing from the fixed manufacturing, and then we're going to want to split up the variable selling and administrative from the fixed selling and administrative, okay, and put that into the variable cost categories and the fixed cost category. So we're going to go ahead first with our variable manufacturing, and this is really the variable piece that we calculated up above. The 100 units at $10, which was the 1,000. And again, this is the same in both scenarios. We're selling 100 units. The variable cost of each was $10. And then we're going to have a subtotal here. We're going to call this manufacturing margin. So we want to see what our variable cost margin is just on the manufacturing. So we've got $2,000 manufacturing margin, and of course $2,000. Next, we're going to, of course, we still have other variable costs. So we have variable selling and administrative expense, and that turns out to be $400. And again, that would be the same for both production scenarios. And then I'll pause for a minute. Maybe you could pause and just think about what would come after our variable costs. And hopefully you remember from last chapter that our next line item would be contribution margin, right? So sales minus variable costs equals contribution margin. So again, in line with our previous income statement, except that we just have a little more detail between manufacturing and non-manufacturing variable costs. So here we'd have $1,600 of contribution margin, again, under both production scenarios. Next, we'd have our fixed costs. And we're going to break those out between fixed manufacturing. And remember here, this is where we're treating our fixed manufacturing costs as period costs and expensing the entire amount incurred during the period. And again, under both production scenarios, we have the same amount of fixed costs we've incurred during the period, and that is $1,000. So that's not going to change based on the level of production. We incurred $1,000. All of that is being treated as a period expense and flowing through the income statement as an expense. We also have fixed selling and administrative expenses of $200. That would give us total fixed costs of $1,200. If we take our contribution margin minus our fixed costs, we're going to get total operating income And in this case, of course, 1600 minus 1200, we're going to get 400. Let me just move this up just slightly. 400 for both production scenarios. And that's the way it should be. Variable costing is not going to be production dependent. Our cost structure is going to be aligned purely based on the demand or the sales number. It is going to have nothing to do with changes or variations in production, unlike absorption, which does vary based on production. So if you look at operating income, there is a difference based on production. If you look at variable cost, no difference based on production. So we had the 900 difference. And again, the difference in scenario 1 between the two methods, if we kind of look here to here, we see that there's no difference. And that's because we sold exactly what we produced. And in that case, absorption cost results are going to be the same as variable cost results, because in effect, under absorption costing, the entire amount of fixed cost incurred flowed through in cost of goods sold. However, in scenario 2, there is a difference of 900 between the two methods. And the reason for that is because under absorption costing, $900 of the fixed costs that were incurred during the period did not flow through cost of goods sold as an expense, but rather were diverted and captured in ending inventory units. But for variable costing, the entire 1,000 flowed through as an expense in the period because it was treated as a period cost. So that's the reason for the difference. So again, what we're really looking at is variable costing being a better decision tool in the short term because of fluctuations in production, may distort the levels of profitability and give you a false sense of what your true profit is, may lead to incorrect pricing decisions or other decisions related to your cost structure. What you're going to want to do is have that cost structure align more with the demand for your product. Ultimately, absorption costing, more in the long term, is probably going to give you a better idea of what your true markup is over your true product cost. And that's why GAAP, generally speaking, uses that for reporting purposes so that over long periods of time and between making comparisons between companies, it's easier to see what the total cost of the products are. But for short term, for internal decision making, variable costing can be very valuable because of the ability to not allow production to distort your cost structure and your profitability. So hopefully that makes sense. It's kind of a different way of looking at variable costing. I think the textbook can be a little bit complicated. As a matter of fact, the only way I really could understand this was putting together these two T accounts and seeing how the costs flow through from production into cost of goods sold, and the fact that under absorption costing, some of those fixed costs end up in ending inventory. That was the only way I could really kind of get that straight in my head in terms of understanding how that works. So I would definitely encourage you to use the T accounts. I think they would be helpful in visualizing how that works. But in the end, I think you need to be able to quantify the differences in the two methods and be able to put together income statements for the two methods. So those would be certainly the basic or the focus for these two chapters, or this chapter rather, chapter 21.